Welcome to the boardroom. Today, we're not just, passively studying for an exam. Absolutely not. We are conducting a high-level executive audit. We're taking Cambridge Accounting 9706, and we're going to transform raw, unfiltered academic data into maximum examiner return on investment. I'm your managing director for this session, and let me tell you from years of experience, the difference between an average candidate and an elite top-tier student is exactly the same as the difference between a failing junior associate and a highly paid executive. It literally comes down to how you pitch your arguments, how you structure your data, and whether your final proposal is actually boardroom ready. Today's target? Well, it's one of the most notoriously misunderstood areas in the entire accounting syllabus: the reconciliation of profits between marginal and absorption costing. Every single year, examiners report massive systemic failures in this specific module. It's a bloodbath out there. So we're going to fix that right now. We're going to deconstruct the traps, build a bulletproof structural framework, and teach you how to engineer a response that hits that maximum A-star mark. So get comfortable, ensure your focus is totally locked in, because we're about to begin the audit.
Here is our executive itinerary for today's session. We'll start with the boardroom briefing, then move into deconstructing the liability. Third up is the structural framework debate, followed by a live compliance audit. And finally, we wrap up with securing the elite deal. Let's jump right in. Section 1, the boardroom briefing. Let's establish our core concepts.
Okay, in any high-stakes corporate environment, before you can fix a bleeding balance sheet, you have to actually understand the underlying mechanics of the business, right? To frame this, I want you to imagine two junior associates that I audited just last week. Let's call them Alex and Sam. Now, Alex is brilliant with raw data. He can memorize every textbook definition you throw at him, but he constantly fails to evaluate market risks. He just regurgitates facts. Sam, on the other hand, speaks incredibly fast, pitches these brilliant, highly creative concepts, but completely lacks hard asset backing. Sam never uses specific textbook case studies or precise mathematical formulas to prove his point. In the strict Cambridge marking grid, both Alex and Sam are massive liabilities. Why? Because they lack a connected conceptual understanding. Principal examiners report this is one of the most misunderstood areas in accounting. To avoid the fate of those unprepared associates, we have to start with absolute precision. The reconciliation of profits isn't just subtracting two numbers. It is the systematic process of explaining the difference between profit calculated under marginal costing and profit under absorption costing, using strictly evidence-based reasoning. Let me unpack the actual corporate mechanics here, just so we are all on the same page. Marginal costing treats fixed production overheads as a period cost, right? Meaning it writes them off immediately in the income statement. Boom, done. Absorption costing, however, treats those exact same fixed production overheads as a product cost. It absorbs them into the cost of each individual unit and actually carries them forward in the closing inventory. Therefore, if your inventory levels fluctuate, say you produce more than you sell, those two methods are going to spit out completely different profit figures. The examiner doesn't just want to see if you can find the final numbers. They want a step-by-step, evidence-based reconciliation that proves exactly where and why that variance occurred. So, the crucial point here is that Cambridge targets exactly three cognitive domains. We're talking about knowledge, analysis, and evaluation. Think of these as the three foundational pillars of your corporate valuation. Knowledge, which is Assessment Objective 1, or AO1, is your raw material. It's your ability to recall formulas and definitions. Analysis, or AO2, is your operational processing. It's your ability to take that raw data, apply it to whatever messy, complicated case study the examiner throws at you, and execute the calculations accurately. But listen closely, because here is the absolute secret that separates the middle management grades from the C-suite A-stars: evaluation, which is AO3. Evaluation is your market value. It is your ability to make justified recommendations, question the underlying assumptions of the data, and compare different strategic approaches. If you only give the examiner knowledge and analysis, like our data-obsessed junior associate Alex, you are literally leaving the most valuable currency on the table. You must master all three to close the deal. Section 2. Deconstructing the liability. Let's take a hard look at the methodology. Picture this. You're in the exam room, and you're suddenly hit with a high-tariff, multi-part Cambridge past paper question. We call this the market opportunity. When candidates see a 15 or 20-mark question asking them to reconcile profits and advise management on which costing method to adopt, sheer panic sets in. What do? They completely abandon their structural frameworks and resort to descriptive text blocking. They just write everything they know in this massive, unformatted block of mud. Let me be clear, that is a critical compliance failure. Command words like reconcile, analyze, and evaluate are strict regulatory constraints. Ignore them, and your valuation drops to zero. Let's contrast a low-value, liability-ridden descriptive block against a high-value executive analytical pitch. This is what we call securing the method mark strategy. On the left side of your screen, we have the junior associate liability. This is basically the Alex and Sam hybrid disaster. Look at it. It features poor formatting, absolutely no headings, and isolated data points that don't connect to the core business problem. Sure, it might actually have the correct final profit video buried somewhere at the bottom, but the examiner cannot follow the logic. On the right, we have the executive director asset. Notice the strict adherence to conventions. There are proper, bold subheadings for the marginal costing statement and the absorption costing statement. The terminology is razor sharp. The annotations are incredibly clear, showing exactly how the over or under absorption of overheads was calculated. Furthermore, it demonstrates cross-topic connections, linking the costing decision to broader inventory valuation principles. This structured, transparent methodology acts as your insurance policy. It allows the examiner to effortlessly award you marks for the correct process, even if you, say, make a slight arithmetic error under pressure. Now, I want you to treat this quote like a direct compliance warning from the principal examiners themselves. When they take the time to explicitly state candidates consistently confuse key terminology, you need to treat that as a red alert regulatory audit finding. Missing these definitions triggers an immediate valuation drop on the marking grid. For instance, students constantly, and I mean constantly, swap contribution with gross profit, or they confuse fixed overhead absorption rate with variable costs. It's a disaster. If you're writing an extended response advising a board of directors whether to use marginal or absorption costing for a special order decision, you absolutely must define the terms you're basing your argument on. Before you analyze the impact, explicitly state it. Say something like, marginal costing only considers variable costs relevant for short-term decision-making, whereas absorption costing includes a share of fixed overheads. Just setting that clear definitional baseline proves to the examiner that you are operating from a foundation of totally secure knowledge.
Section 3. The structural framework debate. Let's establish our procedural framework.
Let's go backstage for a minute. Imagine we're back in the boardroom with our two associates, Alex and Sam. They are currently tasked with merging their individual assets to create the ultimate joint venture answer paragraph. But they are deadlocked. It's a total standoff. Alex is slamming his hand on the table, wanting to overload the opening paragraph with dense, highly technical dictionary definitions. He just wants to dump facts. Sam is interrupting him, talking a mile a minute, fighting to pivot immediately into an analytical counterargument about the ethics of manipulating profit through inventory levels, but without actually doing the baseline mathematical calculations first. As the managing director, I have to step in and resolve this structural debate right now. The solution? It's a seamless, systematic integration of both their methodologies. Comparing these approaches reveals that top-performing candidates exhibit connected conceptual understanding that transfers to unfamiliar corporate contexts. Marginal costing requires you to ruthlessly separate variable costs from fixed costs to find the contribution margin. Absorption costing requires you to calculate an overhead absorption rate and apply it to production. But here is the real executive insight. The critical cross-topic connection here is International Accounting Standard 2 regarding inventory valuation. Absorption costing is generally required for external financial reporting because it complies with the matching principle. Marginal costing, however, is an internal management tool. It's used for short-term decision-making, like make-or-buy decisions. When you highlight these different operational realities in your answer, you instantly elevate your proposal from a simple junior-level mathematical exercise to a C-suite strategic analysis.
Now, what happens when you hit a wall? Whenever our associates hit a structural roadblock mid-paragraph where their evidence beam loses market compliance, I enforce this exact 5-step power-up template. It's the gold standard deconstruct, solve, evaluate sequence required to engineer a flawless, standardized response. Step 1, identify key elements. You have to extract the opening and closing inventory units and the fixed overheads from the messy case study text. Pull the raw materials out. Step 2, apply relevant principles. State clearly whether profit will be higher or lower based on that inventory movement. Step 3, execute analysis with clear working. This is where you calculate the difference in inventory units and multiply it by the fixed overhead absorption rate per unit. Show your math. Step 4, verify results. Does this calculated difference perfectly bridge the gap between the marginal and absorption profit figures? If yes, you've balanced the books. Finally, step 5, make justified recommendations. This is the classic Peel framework in action. Point, evidence, evaluation, link. You make a strategic point. You back it up with the numerical evidence you just verified. You evaluate the wider business implications, and then you link it back directly to the examiner's core question. Follow these steps, and you transform a low-value, rambling paragraph into an absolute A-star asset.
Okay, quick audit pause.
Before we secure a top band valuation and move into the live audit phase of this explainer, you need to ensure your personal academic assets are properly managed. I need you to hit the pause button on your exam stress and subscribe to Ace the Exams right now. Enable that notification bell. Consider this channel your weekly executive board seat. Whether your personal portfolio is focused on Cambridge IGCSE, O-levels, AS, or A-levels, we are here to provide the precise corporate training you need to consistently secure elite grades. Don't leave your academic valuation to chance. Secure your assets, join the firm, and let's get back into the boardroom.
Section 4. The Live Compliance Audit. It is time to test your data extraction skills. All right, I am now officially putting you in the auditor's chair. We've established the theory, we've built the structural framework, and now we need to pressure test your ability to spot a liability out in the wild. In the exam room, the clock is ticking, the pressure is immense, and it is incredibly easy to let your standards slip. So let's conduct a real-time asset inventory scan. If you look at a typical flawed paragraph, can you spot the exact liability that breaches Cambridge marking regulations? Imagine a stressed student writes this exact paragraph. The profit for marginal costing is $50,000, and absorption is $60,000. The difference is because of fixed costs in inventory, so management should use marginal costing because it's easier. I'll give you 3 seconds to run the compliance check. 3, 2, 1. Did you catch it? Where is the breach? The breach is a total, catastrophic lack of quantitative justification and a complete failure to apply context. Yes, the student identified the $10,000 difference, but they failed to show the structural math. They didn't show the change in inventory units multiplied by the overhead absorption rate. Furthermore, that recommendation, quote, because it's easier, unquote, is a massive evaluative failure. It completely ignores the strategic context of the business scenario. It ignores whether the company needs to comply with international accounting standards for external stakeholders, or if they are just doing internal short-term pricing. It's a boardroom disaster.
The examiner reports explicitly isolate these 3 exploits as the main reason student returns drop dramatically. Let's break these down right now. Liability number 1, forgetting proper format. In reconciliation questions, if you do not start with one profit figure, explicitly add or deduct the fixed overheads in inventory and arrive mathematically at the second profit figure, you are throwing away guaranteed easy method marks. Liability number 2, failing to check format and presentation. We're talking about messy crossings out, unlabeled workings, and numbers just aimlessly floating in the margins. If the examiner cannot follow your audit trail, they literally cannot award you the capital. It's that simple. And liability number 3, which is frankly the most fatal of all, providing answers not specific to the context given. If the case study is about a specific manufacturing company facing a sudden drop in market demand, your evaluation of marginal costing must specifically address how it helps them calculate minimum acceptable pricing to survive the downturn. Pasting generic textbook definitions into the answer booklet yields 0 executive value.
Section 5. Securing the elite deal. Let's talk about elite evaluation insights. We have successfully decoded the due diligence scan, we understand the common pitfalls, and we've built our procedural framework. Now Alex, Sam, and you, our newest viewing associate, are ready to present the newly engineered, flawless response paragraph to the board. But to truly maximize the executive value meter and push it to that top A-star tier, we need to understand exactly what the Cambridge markers are prioritizing in the final grading matrix. This chart visually proves that higher order evaluation, questioning assumptions, and justifying decisions with hard evidence holds the largest market share for elite grades. Look at that immense weighting given to AO3. It is the million-dollar asset. Think about it. Anyone can memorize the formulas for AO1. Anyone with enough practice can process the baseline calculations for AO2. But to secure the elite deal, you absolutely must dominate AO3. How do you do that in a marginal versus absorption costing question? You evaluate the alternatives like a true executive. You write something like this. While absorption costing provides a more accurate reflection of long-term profitability by ensuring all production costs are covered, its reliance on an estimated overhead absorption rate can lead to significant over- or under-absorption if actual production volumes deviate from budgeted capacity. Conversely, marginal costing avoids this distortion, providing management with a clearer picture of variable cash flows, which is absolutely critical for the current short-term pricing strategy. Do you hear the difference? That is a C-suite level evaluation. It balances both sides, it questions the underlying assumptions of budgeted capacities, and it makes a final context-driven recommendation. That quote right there is your executive summary. It is the ultimate formula for turning raw accounting data into a million-dollar academic asset. I want you to write this down and make it your exam day mantra. First, you deconstruct the messy data they give you. Second, you solve systematically using proper headings and crystal clear workings to secure every single method mark available. Third, you evaluate the results in the specific context of the business scenario provided, you check your numbers for commercial reasonableness, and you close the deal with a firmly justified recommendation. If you follow this rigorous compliance checklist, I promise you your response will be bulletproof.
As we close this explainer, I want you to ask yourself a very serious question. Is your next proposal going to be a boardroom-ready A-star asset, or is it going to be another messy liability? The choice and the execution is entirely yours. To ensure you stay on the right side of the valuation curve, subscribe to Ace the Exams right now and enable the notification bell for our weekly board sessions. Drop a comment below stating your target grade, your qualification tier, and your hardest subject. We use that exact data to tailor our next corporate training modules. All right, audit adjourned. I will see you in the next masterclass.